Hello there and welcome to Homeschooling Adventures. My name is pjhomeschoolingadventures. In today's video, we are just going to be going through the concept of foreign exchange markets, and in particular, we are just going to be looking at the questions involving the foreign exchange markets, just to try and make the learners and you more comfortable with the exam kind of questions that you are likely going to be writing in the exam, or that you are likely going to be meeting in the exam, should the examiner decide to assess you on this particular component of the syllabus. Now what we now know is remember, this particular video is a follow-up of the previous video. So in the previous video, it becomes very important that we recap on that one. So in the previous video, remember, we understood that a currency depreciates in value when it loses its worth against a major currency. In other words, if we were to go back to the previous video, then you would understand that we were looking at a US dollar to a rand, and then we were saying our rand loses its value when it is now worth less of a US dollar, which would now mean that, for example, if the South African rand was worth 20 US cents, our South African rand would have lost its value if it is now worth 15 US cents. So it means at first our South African rand was worth 20 US cents. When it depreciates, it means our South African rand is going to be worth 15 US cents, and in so doing, it would now mean that our South African rand has lost its worth against a US dollar. And then we also understood that our currency appreciates in value when it is now worth more, okay, against another currency. For example, if the South African rand was worth, one South African rand was equivalent to a 20 US cents, and now we said it has appreciated in value when it is now worth more. Okay, meaning to say, when the currency appreciates, it's now going to be worth, probably one South African rand will now be worth 30 US cents. So our currency is going to appreciate in value when it is now worth more, okay, of another currency. Okay, like in this case, before it was worth 20 cents, we said it depreciated when it is now worth 15 cents, and then before we said it was worth 20 cents, we said it now appreciated when it is now worth 30 cents. Okay, so you need to understand that when our currency depreciates and when our currency appreciates. But you would also need to now understand that when we say our currency is depreciated in value against a US dollar, it would now follow that a US dollar has also appreciated in value against the rand. So when we say the currency depreciated, when our rand depreciated against a US dollar, it would mean that the US dollar has appreciated against a rand. And then when a rand appreciates against a dollar, it would now mean that the dollar has depreciated against a rand. So you now need to understand that relationship that exists between these two currencies. Okay, so in today's video, like I said, we are going to be working with the SIP material 2019, and then I'm also going to be using some resources that I got from the internet just to try and help us analyze the possible effects, certain things that are happening in the environment, how they are going to affect our capital transfer account. So we are going to be looking at that. Okay, so you just need to follow through the video as we go through the questions together. So what I will ask you to do is I will project the question on my screen here, and then I will ask you to pause the video, and then you'll be allowed some time, maybe 8 minutes, 10 minutes, to go through the question on your own. Try to attempt the question on your own, then you can come back and then we'll take it up from there. Okay, so we are going to be going through. So I'm going to give you the first question, and then you'll work through the first question. Okay, so we will allow you some time to attempt this question. Like you can see, it says question 6, it's 10 minutes, so I'm going to allow you 10 minutes to go through this activity, and then I'll be back after about 10 minutes. So what I will ask you to do is just pause the video a little bit and then go through the questions, and then you can then click play when you have finished. Okay. Okay, welcome back. I want to believe that you managed to answer that question. If you struggled with the question, don't worry, we are going to be going through the question together, and probably you will get to understand where you probably went wrong as we perfect yourselves in preparation of the exam. Now, the question reads, study the graph below and answer the questions that follow. Study the graph below and answer the questions that follow. So what it means is we have got to study by studying. First you study, and then what are you studying? You are studying the graph below, and then after you have studied the graph below, then you must answer the questions that then follow. So most of the time learners, they just go to the question and just start answering the question before they even take some time to study. Now remember, you are supposed to study the graph first, and then you can now answer the questions that then follow. You cannot just start by answering before you look closely what is happening on the graph, especially in this component of your curricula. You really need to study the graph first, make sense of the graph, then you can now start to answer the questions. So let me take you through the process of making sense of the graph. So what it means here is we can see that it's demand and supply of foreign exchange, and then I can see that one is my demand curve, that one is my supply curve. It's written SS, and then I see this one is written S1, and there is a point where the demand is meeting the supply. There it's written E, that's the equilibrium point, I believe. And at the equilibrium point we can see that the quantity of US dollars that was being demanded was 100, and then it was demanded, and then the price was 14. Okay, so this one was the price of dollars in terms of the rand. So it means that this was the price of the dollar. So when you say price of the dollar, what we are saying is, we are saying this is the price, this is the amount of money that you pay for you to be able to buy an item. Okay, like if I say price of a loaf of bread, we are saying how much should I pay for me to get a loaf of bread. Okay, now when we say price of a dollar in rand terms, what we are saying is, we are saying this is the amount of money, this is the amount of rands that I should pay for me to get a US dollar. Okay, remember, a price is the amount that you are going to pay for you to get an item. So when you say price of a dollar in rand terms, we are saying this is the amount of money that you have got to pay in rands for you to get a dollar. I hope it makes sense. It makes sense. Okay, so what we are saying here is, we are saying I'm going to pay 14 rands for me to get a dollar, and the quantity that I was demanding, or the quantity that was being supplied by the market, was 100. Okay, and then after the shift of the supply curve to the right, forming a new supply curve S1 with a new equilibrium point, which was now E1, and then at that new equilibrium point E1, this is what is happening. The price has gone to 12 rands, and then the quantity that is being demanded and supplied is 20. Okay, so the equilibrium quantity is 20, and then the price is now 12. Okay, so it means now, after the shift of the supply curve, I'm going to be paying 12 rands, okay, for a dollar. Okay, I hope it makes sense. Okay, so let's go to what we are saying, what we are seeing here. So in general, before we even answer the questions, so what does this mean to me? At short notice, it would now mean that the price of the US dollar has gone down. Okay, it has gone down. Okay, why has it gone down? Probably it could be because they have increased in the quantity of US dollars that has been supplied, and demand has remained unchanged. Okay, that could be one of the reasons. But why? We don't know. But we'll look at that as we go on. Now, let's just go to the questions there. The question 6.1.1, it reads, identify the original point of equilibrium. So it means the original point of equilibrium is the first equilibrium before the change. Okay, where were we before the change? okay, where what was the original point where our demand was meeting our supply. That's the original equilibrium point. And at this point, it would mean you can see that this arrow here is indicating that the supply curve shifted to the right. So because the supply curve shifted to the right, it means it's coming from where? From SS. Okay, so it means the original equilibrium point is this one that is indicated E here. That's the original equilibrium. So identify the original equilibrium point. It means from the graph, the original equilibrium point is E, is point E. That's the original equilibrium point. Okay, and we are saying what is happening at E. We are also saying this is the point at which the price of a rand, of a US dollar to a rand, is 14. Okay, or a price of the US dollar in terms of the rand is 14, and then the quantity that is there is 100. Okay, so we are saying the original equilibrium is the point at which our demand curve DD is meeting SS. That's our original equilibrium point. So our original equilibrium point there, the correct answer to that is point E. That's our original equilibrium. Okay, well done if you got it right. Then you are getting 1 mark there. Then the next question, briefly describe the term forex market. Now remember, learners, when we talk about a market, we said a market is a place where buyers of goods and services as well as factors of production meet sellers of goods and services as well as factors of production, and they exchange these things for a price. That's the general definition that we were using when we're defining a market in the lower grades. Now when we talk about a foreign exchange market, then in that same understanding, it would now mean that a foreign exchange market is a place where the sellers of foreign currency are going to meet the buyers of foreign currency, and they are going to exchange these at a foreign exchange rate, at a rate. Okay, so that becomes the price. Okay, so that's what learners could have said. So our the correct answer there was, we were expecting learners to say forex market is a foreign decentralized market for the trade of currencies, and that includes the aspects of buying and selling and the exchanging of those currencies. Okay, so that would be the correct answer. So if you spoke about aspect of buyers and sellers of foreign currency exchanging the foreign currency for a price, we are going to accept that as correct. You get your 2 marks there. So what is important there, learners, is remember you have got to talk about the buyers and sellers of foreign currency exchanging the foreign currency for a price. That's what is more important there. So it should be the buyers of foreign currency exchanging the currency for a price. Okay, or someone could have spoken of the price as the exchange rate, or exchanging the currencies at an exchange rate or at a predetermined exchange rate. Then we are saying that will be accepted as correct. Then the next one is 6.1.3. What is the effect on dollars when the supply curve shifts from SS, okay, to S1 to S1 when it shifts? What is the effect on dollars? So it's very important that learners understand that this context of this question is, it's asking the effects of the change on dollars. Okay, what is the effect? Okay, and the question here, so it would now mean that it becomes very important that a learner during the exam you highlight effects on dollars. Okay, effects on dollars. It becomes very important that you highlight this in the exam. And what are we talking about? We are talking about the shift, the supply curve, the effect on dollars as a result of the shift of the supply curve from SS to S1, S1. So it becomes very important. So in your exam now, I encourage learners that you need to highlight the paper. You need to highlight so that you don't forget when you answer these questions, and so that you make sure that you have satisfactorily answered what the examiner is asking you about. Okay, so in this case now, you now need to look at it this way. Now remember, because the supply curve has shifted to the right, what it has done is it has increased on the quantity of dollars that is available on the market. Okay, because the supply curve has shifted to the right, it has increased on the quantity of dollars that are available on the market. Now when you look at this increase in the quantity of dollars, what has it done? It has resulted in someone who is in South Africa requiring less rands for them to be able to buy the amount of dollars that are available on the market. Now the question here is, what is the effect on dollars when the supply curve shifts from SS to S1? And then you also need to give your reasons. Now the first thing that we need to understand is the effect of the shift. It has increased on the supply of dollars. It has increased the supply of the dollars on the foreign exchange market. Now you can see at first it was at 100, now it has increased to 120. So it has increased on the supply of dollars. And then the reason, now you are saying the increase in the number of the reason probably why this SS has shifted to the right is it could be because of the number of Americans that are visiting South Africa. Remember, when they are visiting our country, they are going to surrender the US dollars on the foreign exchange market, and they demand our rands. So it could be as a result of the American citizens that want to visit our country, or it could also be as a result of an increase in exports to the United States. In other words, when citizens who are in the United States import goods from South Africa, what they are going to do is they are going to surrender their US dollar on the foreign exchange market and get our South African rand on the foreign exchange market. So what that will do is it is going to increase on the supply of US dollar on the foreign exchange market, because as a South Africa we have increased on our exports to them. Okay, so what it would now mean is it could be as a result of an increase in exports by South Africa to the United States. Okay, and then the other reason that could also be why we now have the supply curve shifting to the right. Okay, it could be as a result of an increase in investment, okay, by Americans in South Africa. In other words, if we have an American company that is investing in South Africa, we are saying through FDIs or through portfolio investments or through any other things like loans, okay, it could be as a result, it causes the supply curve to shift from S where it was to S1. Okay, and that shift is going to end up resulting in an increase in the US dollars that are now available on the foreign exchange market, as the American investor is trying to buy rands so that they can come and invest in our country. Okay, so this could be some of the reasons. So you could have given us any one of those reasons, then it was still going to be accepted as correct. Okay, so those are some of the reasons. So what I was expecting here, it's 3 marks. You can see I was going to give you 1 mark for explaining the effect on the dollars. In other words, we are saying the quantity of dollars has increased. You get 1 mark there. And then the next one, you are now supposed to give a possible reason for this shift. Now that possible reason, you are then going to get 2 marks for that possible reason. So that's why here this one is going to be marked out of 3. So 1 mark is going to be for the reason, for the effect, okay, and then 2 marks is going to be for the reason. So you needed to understand that you were supposed to start by explaining first the effect on dollars, and then when you have explained the effect on dollars, you haven't finished. You are now supposed to go to the second part of the question, which is demanding that you give a possible reason for this shift. So you needed to understand that the question was coming in 2 parts. One part, it was the effect, and the second one is to give us the reason why that has happened. So you needed to understand that. That's how the marks were going to be awarded there. And then the next part to the question was, how will the value of the rand be affected in terms of the US dollar when the SS shifts to S1? So what is going to be the effect? Now you need to understand that the US dollar is depreciated in value. Why? Because we are saying the US dollar at first it was worth you'd need 14 rands for you to get 1 US dollar, okay? Because we have increased on the quantity of US dollars available on the foreign exchange market, it now means that the US dollar now is now worth less, okay? The US dollar now is now worth less. Why are we saying the US dollar is now worth less? It's now worth less because now we now need 12 rands for us to get that same unit of the US dollar. Why has that been so? It has been so because the quantity of US dollars has increased from 100 to 120, okay? So what is the effect? So here now, the learners needed to understand that the effect that is being asked by the question is the effect on, in terms of the US dollar, in terms of the US dollar. So the effect is in terms of the US dollar, and it's how will the value of the rand, how will the value of the rand, how will the value of the rand, so you highlight that, okay? So the value of the rand, how is the value of the rand going to be affected in terms of the US dollar as a result of the shift? So what you needed to understand, learners, is you needed to understand that the rand, it will appreciate in value. The rand will appreciate in value as a result of the shift, because we are saying the US dollar is depreciated. Why has it depreciated? It has depreciated because they've increased in the supply of the US dollars. And then what is the effect on the value of the rand? When a US dollar depreciates, the rand is going to appreciate in value, okay? What could be the reason for what? Then the last part of that says motivate your answer. So the motivation now, why we are saying the rand is appreciated in value, it is now because now we now need less rands for us to be able to buy the same unit of a US dollar. We now need 12 rands. At first we needed 14, but now after the shift we now need 12. So it means now we need now less rands for us to buy a unit of a US dollar. So it means now our rand has appreciated in value against a US dollar. Okay, so this is what learners were supposed to have said, or maybe someone could have said, we now need less rands for us to get a dollar, or someone could have said there is an increased supply in the dollars. So if there is an increased supply in the dollars and our rand remains unchanged, the demand remains unchanged, it would now mean that we are going to end up having the currency depreciating in value. The US dollar will depreciate in value. Okay, so this is what we are saying. So that's what I was expecting learners to have said there. Okay, that was going to be your 4 marks there. So if you have said that and you got everything right, I just wanted to ask you, how many did you get right there? I want to hope that you got everything right, because this one is a very easy section of the ATP. It's very easy topic, so I will believe that you got everything right there. Okay, well done then. I will ask you to attempt the next question again. We are going to go to the next question, and as we go to the next question, I want you to attempt the next question, and we'll see in a few minutes. I'll be back again to do the next question with you. Okay, all the best. Okay, welcome back. I want to believe that you managed to answer the question. Now we'll just quickly go through the question together as you mark your own work. Okay, now the question reads, yes, exchange, so there should be something that is there that says study the graph below, then answer the questions that follow, but unfortunately it just got cut off there. Okay, so we are going to start by studying the graph, and now it says exchange rates. The rand is at the mercy of the market. The rand is at the mercy of the market. That's what it says. And then it says price of US dollars in rands. So what it means now, remember from the previous activity we said price is the amount of money that I'm going to pay for me to get a certain item. So in this case, this is the amount of money that I'm going to pay for me to get a US dollar. For me to get a US dollar, this is the price of the US dollar in rand. So it's very important that you understand that. And then we also have the quantity of the US dollars. We have them. Then we have that was Q1 and that one is Q2. And then we can see that this time around is the demand that has shifted. In the previous activity, it was the supply that was shifting, but in this particular one, it's now the demand that has shifted. So what are we seeing there? We are seeing that the demand has shifted to the right from DD to D1, and then the price, it appears it has increased from 13 to 14, and the quantity has also increased from Q1 to Q2. Now the question here is identify 6.2.1. Identify the exchange rate system depicted in the graph above. Now this exchange rate system, which is determined by the forces of demand and supply, is what is called the free floating exchange rate system. It's the floating exchange rate system. It's the free floating exchange rate system. Okay, that's the exchange rate that is depicted in the graph. So even in the previous graph, it was still the free floating exchange rate system. Okay, right. And then the next question, 6.2.2, what was the original rand per dollar exchange rate before the demand of US dollars increased? So what was the original rand per dollar before the dollar before the demand for US dollar increased? Okay, before the demand for US dollar increased. So what was the original value? So like I said again in the previous, you are saying the original is what you are supposed to answer here. Okay, you are supposed to answer the original. Okay, so the original price is where our supply curve was meeting our original demand curve. So at this point, the price, so we want the exchange rate. So it means the exchange rate, we are talking about the price. Okay, so the correct answer there was 13 rands per dollar. Okay, or 13 rands is equal to $1. Now you need to be very careful on this question. This question here is asking about the original rand per dollar exchange rate. Rand per dollar exchange rate. Okay, maybe I should have also highlighted exchange rate here. Exchange rate. Okay, exchange rate. So what you needed learners to do was you were supposed to give us the price, because the exchange rate, it looks at the price. Okay, we are saying how much should I pay in rands for me to get a US dollar, or how much should I pay in US dollars for me to get a rand. That's the exchange rate. Okay, so if you had written Q1 is wrong, because it's not the exchange rate, it's not the price. You are telling us about the original quantity, original market quantity. But here the question is asking about the price, so you need to look at the rand amount. It should be in rand amounts. So it's very, very important that you understand what the examiner is asking, because if you then give me the quantity Q1, it will be wrong. Okay, because you did not give us the exchange rate, you gave us the market quantity. And then sometimes exams will be asking for quantity, original market quantity. If you give me the price when the question was asking about the quantity, then you are wrong, because you did not give me the quantity, you gave me the price. Okay, so you need to understand the context, what is the question asking, so that you make sure that you answer the correct thing. Okay, right, so the correct answer there is 13 rands. That's the correct answer, because it's the exchange rate, the original rand per dollar exchange rate before the demand for US dollars increased. Okay, so that's 13 rands, correct, and 1 mark for you there. Then the next one, 6.2.3, briefly describe the term exchange rate. Now when we talk about the exchange rate, learners, we are saying this is the amount of rands or of one currency exchanged at the other currency, or exchange to the other currency. So what it means now is it's the rate at which one currency is exchanged for the other. Okay, that's the exchange rate. Okay, it's the rate at which one currency is exchanged for the other. Okay, that's the exchange rate. So in this case we are saying, for example, 13 rands, okay, was being exchanged for $1. That becomes the exchange rate. So it's the rate at which one currency is exchanged for the other. That's an exchange rate. Okay, so if you had said that, you are going to get your 2 marks there. Okay, then the next question, 6.2.4, how does the increase in dollars to you how does an increase in demand for US dollars affect the value of the rand? Now you need to understand this question very clearly, learners, and make sure that you also highlight. We are asking here about the increase in demand, increased demand. We have increased demand for US dollars, right? How does it affect the value of the rand? So what it means is, on one hand we have increased demand for US dollars, and on the other hand we have the value of the rand. So when you answer now, you need to make sure that you have answered how an increase in demand for US dollars is going to affect the value of the rand. Okay, that's very important, because that's what the question is asking. And if whatever that you said did not speak to how it affects the demand, the value for the rand, then it means you did not answer the question, because the question is asking about how an increase in demand for US dollars is going to affect the value of the rand. So it's very, very important that you understand and you make sure that you have fully answered the question. So here the question now says, how has the increase in demand for US dollars affected the value of the rand? Now what has happened here is there's been an increase in the demand for US dollars, shifting the demand curve to the right. Okay, now there's an increase from Q1 to Q2. Now how has that affected the value of the rand? What it has done is it has resulted in me demanding more rands for me to be able to buy the same unit of a US dollar. Like originally, remember, I was demanding for every US dollar I would need 13 rands, but now after the shift, for every US dollar I now need 14 rands. So what has it done? It now means that I now need more South African rands for me to be able to get the same unit of a US dollar. So what has it done? what it has done is it has depreciated the value of the rand. Why has it depreciated? Because now I now need more of the rands for me to get the same unit of the US dollar. I now need more rands for me to get 1 unit of the US dollar. It means now my rands are now worth less, okay, against a US dollar. You understand? If something is now worth less, it means I now need more of that to get just that same unit. Okay, so you need to understand this, and you need to understand it very clearly. Okay, if you did not understand what I just explained, I will ask you to rewind again and listen to this clip again, and so that you really make sense of what we are talking about. Okay, now you need to understand that this now is a demand curve. Okay, so when we said the bottom line to understand this is, remember we said the value of a currency appreciates when we now need when it is now worth more compared to the other currency. Okay, that's when it appreciates. Okay, but now in this case, now the value of the rand is depreciated. Why? Because now it's now a rand is now worth less against a US dollar. Our rand is now worth less against a US dollar. Why are you saying it is now worth less when I now have 14 here? Before it was 13. The answer is very simple. It's now worth less because now it means I now need more South African rands, in this case 14 rands. Before I needed 13, but now I need 14. So now I now need more South African rands for me to be able to get the same unit of the US dollar. You understand? So it means now my currency is now worth less. Okay, if something is cheaper, it means you now need more of that for you to get the same unit. Okay, so that's what it now means here. It now means that our currency is now worth less. That's why now we need more rands for us to get the same US dollar. It's very, very important that you understand that. Well done. I know you have understood what I just said. Okay, so what could the South African Reserve Bank do to strengthen the value of the rand against the dollar? Now, there are a number of things that the South African Reserve Bank can do to try and strengthen the value of the rand. One of the things that they can do is they can actually go and increase or change on the repo rate. They can actually change on the repo rate. If they change on the repurchase rate, this is what it does. If they change on the repurchase rate, it attracts foreign investors into South Africa, because now we are now offering a higher interest rates. Then those high interest rates are going to be an attracting force or a pulling force to foreign investors. So if they increase on the repo rate, it's going to attract investors, foreign investors, to come and invest into our South African economy. So that's the first thing that they can do to strengthen, because now when those investors come to invest into our economy, it would now mean that they are going to what? They are going to surrender their currency as they get our currency. So if they surrender their currency in exchange of higher demand for our currency, that's going to strengthen the value of our currency. Okay, so it means that's the first thing that they can do. They can actually increase on interest rates to attract foreign investors. The second thing that they can also do is they can even get some loans from IMF. They can get assistance from IMF. IMF, it means International Monetary Fund. Now, this is an international board that was set up to try and support member states, okay, or offer financial assistance to member states. We are going to look at that when we look at the correction of the disequilibrium. Okay, so we are going to look at that in the coming videos. But they could also have gone to IMF to get some assistance from there. The other thing that they could have also done is they could have sold the gold reserves. Now, remember we said each country, it maintains, and particularly South Africa, it has a huge amount of of gold deposits. And we said, remember when we were looking at our balance of payment, we said the gold is recorded as a separate item because of its relative importance to the South African economy, and also because of its ability to be used as money on the international monetary system. Okay, so now if the South African Reserve Bank wants to strengthen the value of their currency, they can actually achieve this objective by selling the gold reserves on the international market. Okay, they can actually sell the gold reserves on the international market. What that will do is it will increase on the demand for our currency. Okay, it will increase on the demand for our currency against other currencies. So it means now we would have strengthened our South African rand. The other thing that they can also do is they can even sell the US dollar as in the reserves. Remember, as a country, we also maintain the US dollars as our foreign reserves. So we can actually sell those foreign currency reserves, okay, on the foreign exchange market to try and increase on the value of our currency, to try and strengthen on the value of our currency. So those are some of the things that they could have done. So what did we say they can do? They can even sell the foreign exchange reserves, the foreign currency reserves. In this case, we are talking about the US dollar. Okay, so it means we can sell the US dollar on the foreign exchange market. In so doing, it means we are increasing on the supply of the US dollar, and then at the same time, it's going to strengthen our foreign exchange. Okay, because even those people that want to buy the US dollars from us, they are going to demand our currency. So in so doing, it then strengthens our rand against a dollar. We said they can also try to sell gold on the international market. Okay, our gold reserves. That's the second thing that they can do: sell the gold reserves, and then you strengthen your South African rand. The third thing that we say they can also do, they can go to IMF and get some financial assistance from the International Monetary Fund. Okay, and then the last thing that we said they can also do, they can even increase the repo rate. If they increase the repo rate, then it would mean that it's going to be attractive for foreign investors to come and invest in South Africa, and in so doing, it would now mean that they are going to demand our currency, and they are going to give up their currency and demand our currency so that they can come and invest in our economy, because now it's more attractive now to them to come and invest in us. Okay, so those are some of the answers. So what I was just expecting on this one, because it's a 4-mark question, I was just expecting that learners could have just spoken of 2 things that the South African Reserve Bank can do to try and strengthen the value of our currency. Now, if you have money to do that, that's all about this activity. Now, I'll ask you to mark your work, and then you have put a total there. Well done. I want to believe that you got everything right, and we are going to go to the next question. Now, in the next question, I'm going to give you some more time to do the next question, and then we'll meet in the coming few minutes. Okay. Okay, so now welcome back, and we are just going to be looking at this one. It says here, the question says, evaluate the benefits of competition on global market or international trade. The benefits of, so like what we said you highlight the benefits, so you are supposed to discuss the benefits of competition. Okay, the benefits of competition on global markets. Okay, on global markets. Okay, and remember the verb here, we are supposed to evaluate. Now when we say evaluate, it means you need to be looking at probably the success and failures and those other things. Okay, you should analyze it in greater detail. Okay, I believe you already know what the word evaluate means. Now we are just going to be evaluating. What are we evaluating? The benefits of competition on the global markets. So what we need to understand now is when we have competition, it increases the level of economic growth, because the competition, it results in it, or it forces businesses to look at more competitive way of producing goods in an attempt to remain in operations, in an attempt to remain in business. It would force that businesses to look at more productive ways of producing goods and services. Okay, so you would now need to understand that competition, it increases economic growth, or it stimulates the level of economic growth. That's the first thing that you need to understand. You also need to be to understand that when there's international trade, it allows the development of facilities. Such facilities, like you would obviously know that the transport network systems would also need to understand things like a harbor, because we are going to be importing and exporting products. So it helps in the development of such infrastructure, and that infrastructure is very important for economic development. And then you also need to understand that when we have competition, or when we allow competition to exist as a result of international trade, it brings a variety in a country. In other words, it allows the citizens in South Africa to gain access to other products that are coming, or that are made by other countries, or that are coming from other countries, and those products which are most of the time which are more superior products. Okay, so that would now give access, or it increases access to better quality products, okay, in the country. Okay, and then it would also result in an increase in the standards of living of the country. Okay, so it also increases the standards of living of people in a particular country, because now we have access to more superior products. It tends to increase on the standards of living. And then the other benefit that we have with international trade, competition on international trade, it creates employment. Remember, we said the domestic economy is a smaller economy than the rest of the world. So it means if we open up to international trade, it allows South African businesses to be able to sell to the both domestic economy as well as the rest of the world. So when they are to sell for the rest of the world, we are saying the amount of demand that is there is a vast, there is a plenty demand. So it will force the domestic businesses to step up in terms of production. Okay, which would now mean that the households are going to benefit, because more factors of production are going to be bought from the households. Okay, labor, natural resources, all those things, they are going to be bought from households by businesses as they try to increase on their levels of production, and they are producing for what? For the international market. So we are saying it increases even the consumption of factors of production by local businesses. So that, what is the benefit of that? It means it creates employment. It betters the standards of living for the people that are in the country. Okay, so those are some of the benefits. Okay, so I want to believe so, because this one is an 8-mark question, I was expecting learners just to discuss any 4 of those, then it was going to be accepted as correct. Now I'm just going to post the extract here, and that extract I will ask you to look at it, read through it. It's a document that I got from the internet, and this one was particularly looking at the capital flight and the South Africa, the investors who are leaving the country to go to other countries, and that's why it was of keen interest to us. But I'm just going to give you this slide, and then you can now read through the document, and then when you have read through the document, let's understand what they are talking about there. Okay. Now, What generally this document is talking about, I just downloaded it from the internet. It says international investors have had enough of South Africa and are taking large sums of their monies out of the embattled country. The City Press reports that over 100 billion of South African shares and bonds have been sold by international investors since the start of 2023. And then we have all those other things. Then the last paragraph, it says the pace at which foreign investors are disposing of our stocks and bonds seems to be accelerating. And this one was said by the CEO of DFM Global, JC Law. Now, if you look at this, why I have taken this particular one to be of key importance is we looked at our balance of payment, and in particular we looked at what is called the capital transfer account. Okay, now I just want us to go back again to the capital transfer account and understand certain key things that will help us understand the context of this article here. The first thing that we need to understand about our capital transfer is we said our capital transfer, it records the balance that is supposed to be shown as a net amount. The balance in a capital transfer account, we said it's supposed to be shown as a net amount, and then we said this amount, it can either be negative or it can be a positive amount. Okay, in other words, remember we said whenever we have more receipts, then we are going to be adding, and whenever there is a payment, we are going to be subtracting. So if investors come into the country, it means it's going to increase on our receipts. Okay, so it means it was going to be positive. If they leave, then it means it's a negative. Okay, so now this is what we are saying now. The question here then that I have in mind is what could be the effect of these investors leaving the country. What is their effect on the capital transfer of South Africa? What is the effect of the disinvestment by foreign investors on our capital transfer, and to what extent is this going to affect our balance of payment? Now, what we need to understand now, learners, is remember we said our capital transfer, it includes the transactions and grants that relate to ownership of fixed assets and other assets that that are going to be that are owned or that were owned by migrants in the country. Okay, so every time when we have the capital outflow, like when people disinvest, sell bonds with their foreign investors that are selling our bonds, or the foreign investors that are disinvesting from our stock markets, or they are foreign investors that are just liquidating their investments and leaving the country, what it does is it reduces on the value of our capital investment in the economy. It reduces on the value of the capital investment in South Africa. And what that would now do is it has a long-term effect. Sometimes it can even end up resulting in high levels of unemployment. Why is there high levels of unemployment? It is because most businesses are liquidating, or most businesses are closing. So if that happens, then it increases on unemployment rates. And then sometimes you would also find that it's depending on the size, but it's going to end up affecting even our balance of payment. Okay, so these are some of the things, but I just posted the extract there so that you can just read through it and understand these are current affairs, these are issues that are happening around us, and we really need to understand things that are happening around us, especially as economic students, because these are things that you would generally expect even examiners to be examining you on, especially in your section B. You can just get an extract and then they can ask you a lot of questions like how can the South African Reserve Bank reverse the negative impacts or minimize the negative impacts of the exodus of investors or the disinvestment. You understand? So that's when now you now need to look at things like increasing the repo rate to try and attract more investors into the country. And then you would also need to understand even issues of load shedding. They also need to be brought into perspective, because those are some of the things that are going to affect the investor sentiment, okay, and the willingness of investors to come and invest in our country. So that's what I had for you today, and I wish you all the best. It leaves me just to wish you all the best in your studies, and in the coming videos I would hope to meet you again, as we will be continuing with the subject of economics, and as we prepare for our exams. Good luck in all your studies. All the best. And if you like the video, click the like button and remember to subscribe to the channel. All the best. I'm out.